is it a bull run or a bull trap? And we're talking about risk assets generally. But I think in this discussion, there may be some different discussions with, let's say, US stocks, the US stock market, and crypto, because I'm starting to see them a little bit differently. There seems to have been some decorrelation. But let's start with US stocks. You can see here, this is the S&P 500. The very bottom line that's red at the very bottom is the 200-week moving average. Mm-hmm. Simple moving average. You can see it broke only during COVID. So that was, I guess, 2020.
During the recession.
Down. Yeah. Other than that, I believe it has not broken the 200 weeks since like 2013, if you look way, way back.
Since the last recession.
Yeah. So at obviously 2008, you had a massive breakdown, but then we've been above it mainly the whole way since 2009. You've then got the 2022 crash, the inflation scare crash, where you touched the 200. Dave's got it right there on his cursor. It touched the 200-week moving average. That was an inflation scare that took us out of some all-time highs. The S&P was 4,800, and it took us down to 3,500 is where we touched the 200-week SMA. So we fell quite a bit there. At that point, that was 2022, and we've had a bull run from then up until, a couple weeks ago. What, 6 weeks ago, 8 weeks ago?
Where was the peak? The peak was in the middle of February.
Right, we've been falling for about six to 8 weeks.
Okay, yes.
Is that correct? We went down to what? 4,900, 4,800?
Almost 48, almost.
Right, and you did call that. You called in your last video when we were talking that there would be about a 20%. Was it a 20% drawdown?
I think I mentioned below 5,000, yes, but I actually thought like later this year, not immediately, but okay.
We've retraced half of that, though. We've retraced. So the high was 6,100, and we're at around 5,600 now, which is not even, is at 10%. So we've retraced half of that crash very quickly. It looks like a V-shaped recovery as we speak right now, but we'll see how much farther it goes up. But in any case, the recent, we'll call it the tariff crash, was the largest crash since COVID, okay? That was the largest pullback since COVID, larger than the 2022 recession crash. The tariff crash was bigger. I think at least half of that move is profit taking, however. Question goes back, is this a bull trap, or are we back in a bull market, right? Now, I will say, just to get things started, when you think of what a bubble is, when we talk about a bubble, bubbles rarely have three major crashes in such a short period of time. So again, we had the COVID crash, we had the 2022 crash, and we had the crash this 2 months ago. So we've had this bubble has been challenged 3 times, just to put it out there. So why don't I go to the slides I prepared, unless you have anything else on this? Yeah. Sure. And I'll start with the bear arguments. We had a large US stock sell off of 20%. And I think the bears are probably right that this might have broken the hyper bull big tech sentiment, right? It took a lot of money out of the Mag 7, and the big tech market caps fell a lot. A lot of people thought that was overdue, and their PEs were much too strong, and they were correct that there was a lot of money that came out of that. So I think some of the momentum for stocks has been damaged. I knew Trump was going to play with the tariffs, but he was more aggressive than I thought he would be. And I think he surprised the bulls for really scaring a lot of people. And the question is, will that damage be permanent or, get into the, trigger a recession, for example? The Q1 GDP was negative. I think it was it minus 0.5%? Dave, do you remember the number for Q1?
I remember the number, yes. Okay. It was around 0.4 or somewhere there.
Okay. So assuming there's some lag time, Q2 might be negative as well. And then we've got a technical recession because 2 subsequent quarters of negative GDP is a recession. So you will get your bear recession, but it might be quite shallow. That said, the headlines will say recession, recession, recession. And for sure, the legacy media will try to scare people, and it could have a self-fulfilling prophecy effect where your average retail investor sees recession headlines, gets scared, and it becomes a self-fulfilling prophecy. So I am concerned about that. We had 177,000 new jobs on Friday, which is good. Unemployment rate is still at 4.2%, but I think those job losses could be coming in quarter or the next couple months, right? So what I'm saying here is I don't think we're going to get a V-shaped recovery back up to all-time highs. I think we're going to get more of a slow grind. We might hit S&P 6,000 by December, but we're not hitting the 6,500 to 7,000, which I'd said in January. So I'm tempering down my bullishness. The tech companies are probably not going to be paying so many high salaries. Young investors have not seen a recession or bear market, so we don't know how they will respond. Like we said, we haven't been below the 200-week moving average since 2009. Most of the people on the Twitter were in elementary school in 2009. So the young retail investor is very inexperienced in terms of what bad markets look like. Okay, so those are the bear arguments. Do you have any comments on that?
Yes, I do. So first of all, I'm enjoying you bear arguments because I'm not that much used to them because you're generally bull. So first of all, I really enjoy this slide. Also, uh, two remarks about the GDP initiative. We had the same in 2022. I remember we were doing our podcasts throughout 2022. We had like 20 of them or even more. And I remember there were two consecutive negative quarters in 2022 at that time. So it was a recession at that time. So we thought. But they were around zero still. And then they got revised again. And then they changed the numbers retrospectively. So today, when you look back, I think it's only one quarter that was negative in 20.
Yeah.
Now about the ferocity of the crash below 5,000. Yes, it is just like you said in the previous presentation. I remember you saying that because we were 5,700 when we were recording in the middle of the March, and I think you said that well, like if we would drop this low, like this is a heavy boat. This is not a speed boat. S&P 500 is. And it's not that easy. You can't turn it around that quickly. Like it will probably take some repair work. It will not just come back to all-time highs instantly in a V shape. So those were my remarks. Okay, I enjoyed this one. Let's go to another one.
Okay. Yeah. And then back to my bull, my bull arguments. So yes, I said that if we went down below 5,000, that this could really slow, kill sentiment and slow the market down and change how people are thinking. But we did recover, and profits needed to be taken anyways. You could argue that 10%, which is the net from 61 to 5,600, was profit taking, and it would have happened anyways sometime this year. We may have gotten that out of the way, and this may set up a stronger second half of the year. The other thing is, my second point there is everyone is bearish already, and they've been bearish for a long time. So there's been lots of bears in the market for the last 3 years, a lot of very stubborn bears. People have been bearish, and especially now they're very bearish. They're very worried about Trump and tariffs, a lot of complaining. And so you could argue, you could be contrarian and say a lot of the bearishness is baked in, and yet we're still at 5,600. I make my point here about bubbles. They typically don't have multiple large sell-offs. We've had 3 large sell-offs since 2020. So 3 in 5 years, right? We had the 2020 COVID crash, the 2022 inflation scare, and now the 2025 tariff scare. U.S. credit spreads are relatively low. I sent you a chart there of U.S. credit spreads. This is credit spreads. Basically, this chart shows what we call risky high yield bonds versus quote unquote safe U.S. treasuries. Okay, so it's risky bonds versus safe bonds, and there's a credit spread, which is the difference that bond traders will pay. So basically, a lower credit spread means bond traders think the market is safe. We're not getting a major crash or a global downturn. Okay. So you can see from 2020, credit spreads were very high. That was during COVID. Okay. In 2022, you see a second one. That was our crash because of the inflation scare. And then you can see we just had our tariff scare where it spiked and now we fell again. But the overall trend is down, right? So according to bond traders, the world is getting less risky over a 5-year period from 2020 to 2025. Bond traders are known to be very risk averse, very smart, very analytical, very data driven. And some people will say they're smarter than the stock traders, or at least more disciplined than the stock traders. Any comments on that, Dave?
Yeah, I have a remark. Yes, I would like to see how this chart looked like. I would like to see 2019 because I would like to see if the bond traders thought that something like this was coming, because or if they were saying that the risk was low in 2019. Do you know how this spread was?
I don't have that in front of me. I can guess it was much, much lower than that 2020 because COVID surprised everyone. The bond traders are saying, again, it's all relative. There's always risk in the markets, but on a relative basis, risk is lower and trending down on a 5-year period. The next one, real estate prices in the U.S. are not falling, and they won't fall. They're not going to fall. So I was saying U.S. real estate, there's just not enough supply. They're not building fast enough. They haven't been building fast enough since 2009 because banks were just not lending after the great financial crisis. So, and then 40 to 50% of U.S. houses have no mortgage, right? So there's no pressure to sell. The boomers are sitting in their houses. And of course, real estate is the number one asset for net worth. A lot of these people are sitting on very valuable houses and it makes them feel good. It supports sentiment, okay? Next one is just M2 money supply. Money supply is going back up globally, and we know how that affects the crypto markets, but it also affects all risk assets. And there's often a lag of about 3 months. If you map Bitcoin and M2, it follows extremely closely, but with about a 3-month to 6-month lag. And it seems to be doing that again. So that's interesting. Unemployment is at 4.2%, which is historically extremely low. The bears have been saying we're going to get it's going to go up, but it keeps sitting somewhere between 4 and 4.2%. I believe it's been a year at that level or more, has it not? I don't have a chart in front of me, but it's very low. Next, we have the Fed, the Powell Put, meaning he's going to cut rates soon if we get a recession, if we get more job losses. Fed, Powell is going to cut. The Trump put is just as important. He always wants to win, and asset prices are the proxy for how he will declare he was right. And so I think there's some positive headlines on the way. Tax cuts, pro-U.S. business policies. There is a lot of anti-Trump sentiment. I think he's going to react to that by saying, aha, I've got the stock market up again, and look at me. So if only because he's arrogant, I don't care. There's a Trump put there. My next slide that David can pull up is the $7 trillion US cash on the sidelines. This is money in money market funds, total financial assets. So what does that tell you, Dave? What do you think when you see that chart?
What I think that the money printer is going brr.
Yeah,
This
but
is the last
that's money in
100
people's
years.
accounts, right? But that's in people's bank accounts, right?
Okay.
So that's not money sitting at the Fed. That's money sitting in like brokerage accounts and bank accounts, which is a bull argument on some level. At least dips will be bought, and or there is dry powder for people to at least slowly keep buying stocks. And then finally, U.S. boomers are still at all-time levels of wealth. So the stock market is back to 5,600, which is just off the all-time high of 6,100. So they're as rich as they were 4 months ago or 3 months ago, and their real estate's gone up. So they were at, historically, boomers are as rich as they've ever been in history. So They're not scared or panicking yet, let's just say, right? My
So
final slide conclusions. Oh, go ahead, unless you've got a comment.
yeah, I have actually one comment about this exactly about the M2 money supply, and you even mentioned the correlation with Bitcoin. I have a lot of things to say about that. I will not spoil
Okay,
it though for you. You have to be watching the presentation, and by the time the presentation ends, all parts of it, by the time I will address it quite a lot, and also so good that you
great.
mentioned this point. I will come back to it.
Okay. So we can go to my conclusions. And this is more personal. This is just me. In January, I did a market, I think it was January, on my Twitter. I had my 2024 results. And there's a video there if you'd like to see. But I sort of summarized my results from 2024, which were very good. I had my best year ever by far. And big winners were Bitcoin, MicroStrategy, Palantir, Tesla, and a few others, Sterling Infrastructure. But basically, crypto, Bitcoin, MicroStrategy, proxy for Bitcoin, and Palantir. So you can watch that video if you'd like, but it's been about 3 months. Compared to then, I am now more neutral on stocks. So I've gone from being bullish on stocks and saying we're going to get to 6,500 or 7,000. I'm neutral. I'm not buying stocks, but I'm not short. So I think it's more likely than not we grind up to about 6,000 by the end of the year, but we also could have go lower. Based on the bear case I talked about, there is a chance that the anti-Trump tariff sentiment gets worse, or China does something crazy, or investors burn out and there's more profit taking and we turn, or recession or job losses. So I'm neutral right now. There is risk of further downside. But if I was to flip a coin, or if I was to choose, I would say maybe 60% chance we go a little bit higher this year. Okay. So I'm not buying stocks, but I'm not shorting. I did think maybe it's time to put some sort of like a put option, like a short, like a buy some puts on the S&P, but I'm not really that type of trader and I'm not that confident. I would say if we start like flatlining or go below 5,600 for 3 to 6 months, that would be a good time to put a short on, but I think it'd be too soon. In any case, moving to crypto, I'm bullish on crypto, especially Bitcoin, but I'm not buying crypto because I'm already fully invested. Okay. So would I advise someone to buy it? Perhaps. I mean, we're almost at all-time highs, so maybe not, but I think we're going higher. And it's very interesting because therefore I'm saying there's going to be a decorrelation, or at least somewhat of a decorrelation between stocks and crypto. Because if you'd asked me a year or two ago if stocks would crash 20%, what would happen to Bitcoin? I would say it would go much lower, and it didn't. It held. And so that's very exciting. I think that's a very good news for crypto bulls, that there would be decorrelation if this holds, right? We don't know if it'll hold. So I'll be selling 20 to 30% of my positions if we get strength. So as Bitcoin rises, MicroStrategy, Palantir, if they keep going higher, I will sell positions into that 20 to 30%. I think Bitcoin gets to 125 to 175K by December. MicroStrategy will therefore at least double or triple to $750 or $1,000 per share. It's at about 400 now, so it's at least doubling, probably tripling. Palantir is hitting all-time highs today and has earnings out today, and it's doing much better than I thought. It's recovered very well, and I think it could go to 145 to 165. Tesla will recover. I'm not so sure if it'll surge, but I'm a long-term holder, and I think the worst has come, because it couldn't have got worse to where they're actually burning down Tesla dealerships. You can't get worse than that. So I think it's probably going to do okay. Another thing I'm doing is I'm selling options, puts and calls as income to hedge my positions. I bought MSTY, which is a MicroStrategy income fund. And I'm looking for new investments to diversify. So especially fixed income, send me your ideas. This will be, when I sell the 20 to 30% of my position, I'm promising myself I'll go into some income for more of a long-term strategy there. Okay, that's it on my conclusions.